What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode, I'm doing another stock market technical analysis update. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along on my updates. Now, first up, we're looking at the ticker symbol SPY, which is the SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. All right, so we see with today's close on the S&P 500, we did go up a little bit higher today, and we can see that we're still trading at the top of the Bollinger Bands here. Now, we did see a lot of price swinging, and we see that the price closed right about where it opened, even though we see the wicks on this candle went as high as $350 and as low as $346 today. Now, this is a doji candle, which signals a lot of indecision, and we did see a lot of swings in the market from high to low prices all day long. So if we switch over to a 1 hour chart, we see here that we really didn't go anywhere all day long, even though we were trading in about a $3 range. Now remember, we still have this gap below us. In any event that we get a gap down, this could turn into another island reversal like we saw back in June. Now we're also getting dangerously close to our upside price target at 353. And as we reach these price targets, it's increasing the chance that we're going to see that correction pullback. So in any event that we get a correction, we do have these support levels at $340, $332, $330, and $327. Now this is a lot of support below us, so this market can continue to stay bullish, and this trend can continue to go higher even in the event that we get a pullback. So the biggest pullback from today's close to the bottom support level we have down here is about a 6% pullback, which is very likely, and it's still a very bullish correction that we could continue to see upside even if we get a pullback that takes us all the way down to $327. Now, right now, we still see the price action extremely bullish, still closing well above the 5 EMA, and it's showing that this bullish momentum is not over yet. And that is why I have been saying in my videos, do not try to call a top and do not try to short the market because you think it's too far stretched. This market could absolutely still short squeeze and go parabolic, and there's no reason to expose yourself to the risk of shorting in a market that is this extremely bullish. So one thing I like to keep track of on this channel is the bear bull survey, and we still see the majority of people being surveyed are in the bear camp, with 39.6% of people bearish. Now, historical average is about 30% of people bearish, so we still do have more retail investors that are bearish in this market, and smart money knows that. Remember my video from last night, how does smart money trade in the market? Smart money accumulated and bought their positions in the bottom of the lows of the crash in March, and they are not selling. They're holding their position, and they're letting all of the retail investors FOMO in. They want you to come off the sidelines, and they want you to throw your cash into this market so that they can sell to you at higher and higher prices. Now, if you look at this survey, this shows that the majority of people are bearish, which means they're either not in the market or they're trying to short the market. If they're not in the market, they could simply flip to be bullish at any point, and that is money that is on the sidelines that could still flow into the market, causing it to continue to go higher. If they're shorting the market, they can continue to cause a short squeeze where they have to cover their short position at higher prices as they get margin called if the market continues to stay irrational and goes parabolic and continues to go higher. Now, the historical average of the bulls is 38%, and we're at 32%. So there's still room in this market for people to flip from bearish to bullish, and that could be just enough momentum for us to see this last melt up and this last short squeeze to really get a blow off the top price action in the stock market. So remember, most people are still bearish, and there's still more bears than bulls. And we have technical indications of price action and technical indicators that tell us that this bull market is still extremely strong and wants to continue to go higher. So I'm trying to keep you guys on the right side of the money here, and I'm trying to explain the concept of smart money so that you won't be the dumb money FOMOing in at the top. Now, that's not saying if you're a great trader and you're getting in and out quickly that you can't still scalp a position, but generally speaking, at these valuations, and we are nearing the end of this parabolic melt up, you really don't want to try to time your trades because the market could sell off at any day now. And we have indications that tell us that that is a possibility. So going back and looking at this chart, you see that there was a lot of volume back here in the crash, and that volume has still tapered off. And even with today's volatile price action, we don't see any abnormal volume, which is telling us that that smart money is not dumping positions yet. That's not to say that they're not selling small amounts, but we really are waiting to see those large volume spikes like we saw back here in June, where we did see the VIX spike and we saw a couple of weeks where the market was volatile and there was a lot of selling. Now, of course, that was only wave 3 of this run up. And now that we're in wave 5, this corrective wave and this corrective sell-off could be a lot more significant. But right now, I'm telling you these support levels because these are the levels that we're going to look for support in any event that there is a correction. So we do have about a 6% downside before we would expect to see some kind of bounce. So if you're already long on this market, there's no reason to panic sell. You always have the opportunity to sell at support levels on the way down in any event that we do start getting a correction. If you're on the sidelines, it would be a little ridiculous to try to buy a long position at these price levels. And I do think that there's a correction that's coming soon that you'll have a better buying opportunity. So with that being said, we still do have the higher price target on the S&P 500 of $353. And with today's close, that's still about $5 higher. So the main point I want to make on the S&P 500 is remember that this market could continue to go higher. And right now, all of the price action and all of the technical indicators are still extremely bullish. So remember, we want to see a sign of a reversal before we say that the top is in. And right now, it does not look like we are at the top of this market, believe it or not. So now let's jump over to the Nasdaq 100, which is our QQQ ETF. And we see here that the Nasdaq 100 took a little bit of a day to cool off. And if you remember me saying yesterday, when we close above the Bollinger Band, we typically need a retracement and a cool off to allow the price to get back into a more reasonable trading range. And right today, we see that we came down and closed right on top of the Bollinger Band. So this is still an extremely bullish price and an extremely bullish technical indicator that's showing the price is riding the top of the Bollinger Band. And we're still not getting a drastic sell-off that's bringing us below the 5 EMA. So remember, we did hit our upside price targets on the Nasdaq 100, and we're still watching this next level higher on our Fibonacci extension level of $300. As long as this market continues to melt up in this last wave 5 of this bull run, we could still see these higher price targets. Even though they are high stretch values, that doesn't mean that they're not going to happen. So remember, on the Nasdaq 100, we really want to see this 5 EMA start to show some weakness and start to cross under the 13, and we have yet to see that. So just remember, this is not a great time in the market to try to call a top and short. I'm trying to protect you and keep you on the right side of this market. And even though there's a lot of warning signs and it looks like the market can't go higher, I'm telling you right now that we could still see these higher price targets of the Qs at $300. So let's now jump over to the Dow Jones Industrials, and we're looking at the DIA ETF, and we do see the Dow Jones went up over 0.5% today. And that should be no surprise looking at this bullish setup. We did have a test of support, and we've already bounced and we're continuing to head higher. And at this point, we're only about $4 away from closing the gap that I said is our price target of $289. And I can't see any reason why the Dow Jones would have any trouble in coming up here and closing this gap before any amount of correction that we would see in the stock market. So at this rate, we could literally close that gap by tomorrow or early next week. So look for the Dow Jones DIA ETF to continue to go higher and hit this $289 level before that gap is closed from the March crash that we saw back here at the end of February. Now the Dow Jones has still not formed a new all-time high, and this could be another warning sign if the Dow Jones closes this gap and then starts to continue downward after this bullish run. We would want to see the Dow Jones join the S&P 500 and the Nasdaq 100 in forming new all-time highs to let us know that all of the indices in the stock market are starting to move together. But right now we do have a bullish trend and we have to respect that, and right now that's giving a higher probability chance that we're going to see this higher price target. So let's now jump over to the VIX, which is our fear indicator. And if you remember me saying early this week and last night, with the evidence that we're seeing the VIX creeping higher as the market creeps higher, I did expect to see a highly volatile day and a big spike in the VIX, and that's exactly what we had today. You can see here by the wick that the VIX at one point had gone all the way up to the 200 simple moving average before ultimately closing down lower at 24.5. Now this 24.5 level is still above our 23.5 resistance level that we wanted to see the VIX get rejected at, and we do see that we had a warning back on August 11th where the VIX kind of poked its head up above resistance but ultimately came back down and tested support again. So we still see the VIX forming this pivot bottom of support, and I do expect to see the VIX continue to climb. Now remember, when the VIX goes up, that typically means that the market's going to go down. So you have to be aware of what the VIX is doing, and right now it's flashing warning signals right in front of us, and the VIX is actually going higher as the market continues to go higher, which is a huge warning flag. And I know there's a lot of bullish momentum in this market, but eventually the big smart money will decide to dump their positions, and we could see the VIX spike into the 30s or 40s very quickly. And we saw a little hint of that today with how quickly the VIX went all the way up to about 27, which at one point in the day, the VIX was up about 16%. So watch out for the VIX and watch out for this warning sign, because it's telling us that there's fear in the market, and that fear could lead to a huge sell-off. Remember what I've always been saying, that the SP 500 is taking the stairs up. It's been climbing and grinding higher one chunk at a time, and it's continuing to form these new highs. And we do see here that the price is increasing rapidly, and that means we could be setting ourselves up for the elevator down, and we could close these lower gaps very quickly in any event that there's a sell-off. And that's why we're respecting the VIX. And the fact that the VIX is continuing to go higher, even though the market is going higher, is giving us a warning sign and telling us there's some underlying issues in the market that we might have to start paying attention to. So looking at the VIX again, we do see it starting to break higher, and we saw the 5 EMA cross above the 13 EMA, as well as the 13 EMA crossing above the 20 simple moving average. So I do expect to see the VIX have some bullish momentum, and I would expect to see the VIX continue to climb. So remember, when we see this happen, that means a sell-off could be right around the corner. So just position yourselves in your investments and your trading strategies to be content in any event that we have a market correction. You don't want to be all in and have to sell for a huge loss in any event that the market has a significant 7 to 10% pullback. Now let's go ahead and check out some of the other sectors driving this market. And first up is the financials, and we do see the financials regained its bullish momentum with the 5 crossing above the 13 EMA a few days ago. And we did see that momentum carry on with today's price action closing up about 1.69% higher. Now I did draw another resistance trend line in here on the financials that captures these other tops that we've seen, because the financials have yet to form a higher high. So we really want to see the financials come up here and break through these resistance levels and ultimately break through the 200 simple moving averages and form a higher high. That will show us that the financials are going to join this bull rally, and we really want to see the financials join the bull rally if we're expecting to see the S&P 500 continue to go higher. So right now, everything's looking great with the financials, and we're only a few days away, if not a couple of days, from testing these critical resistance levels. So we're going to learn a lot about the financials in this market very soon. Now jumping over to the industrials, we do see the bullish momentum continuing with today's close above the 5 EMA yet again. So right now, the industrials are still looking very good, forming a higher high, and we still see a very bullish setup with higher highs and higher lows. So right now, we have to give the benefit of the doubt to these bullish trends that we're seeing all around in these sectors, and that's telling us that it's not time to short this market and that this market could continue to go higher. So look for the industrials to continue this upward move as long as we see the 5 EMA continuing to go up and staying above the 13 EMA like we're seeing here. Next up is the healthcare sector, and we do see that healthcare finally had a day where it decided to go higher, and we're still trying to break out of this sideways consolidation move, but we do have the 5 EMA still very bullish and still trading above the 13 EMA. Now remember, I was saying the healthcare sector looked like it was showing some signs of weakness, but it looks like it's starting to regain some of its bullish momentum with today's close, and we do see the 5 EMA starting to break back above and show a sign that it wants to start running and break away from the 13 EMA. Now remember, a sign of a reversal in the healthcare sector would be the 5 EMA crossing below the 13, which would be an early warning sign for us that this bull market could be coming to an end and we're ready for that correction. Next up is the US dollar, and we're looking at DXY, and even though the US dollar did close up a little bit today, we're still trapped in the middle of this resistance and support channel that I have drawn out. So we're not going to guess if the dollar is going to go higher or lower. We're going to simply wait and watch if the dollar is going to break out to the upside or the downside. But right now, the dollar is sort of taking some time to consolidate, which is no surprise because it's been on a very drastic sell-off downward momentum move, and it could just be digesting and consolidating before continuing that downward move. But we really want to watch it and see which direction it's going to break, because as the dollar weakens, we're going to continue to expect to see asset prices inflate. Now, if the dollar starts to strengthen, that's going to tell us that we're that much closer to a stock market correction. We would see asset prices come back down and see some sort of correction. All right, next up is gold, and we do see gold is getting dangerously close to breaking out of this consolidation pattern, and we did have a wick above the consolidation pattern in the midday trading today, which looked like gold was about to break out of this wedge to the bullish direction. But right now you can see we did close back inside the wedge, so we're still going to wait and watch to see, maybe just a couple of days away from knowing now, if gold is going to break out to the upside or the downside. So gold falls in the asset prices, and we would expect to see gold continue to climb higher if we see that dollar weaken. So we're going to watch all of these sectors and all of these industries very closely, and there's going to be some good trading opportunities coming very soon. Next up is Apple, which is our market moving stock. So we want to see what's going on with Apple, and we do see Apple closing about 1.2% lower today. However, if you look at this trend, it is still very bullish and the price is still trading above the 5 EMA. So there's still all of the bullish momentum in this stock, and we're not calling a top because Apple's not showing us any sign of weakness just yet, and we really want to see Apple start to close down below the 5 EMA, and we really are waiting to watch the 5 EMA come down and close below the 13 EMA. In any event that we see that reversal, we're fully expecting to see Apple come back down and test its breakout where it left this gap open before ultimately continuing an uptrend. So all around, we're seeing very bullish trends all over the market, and that tells me that it's still not time to call a top, and it's still not time to try to short this market. We could continue to see short squeezes and melt ups for many more days to come, and even though the VIX is showing some warning signs, that's not enough to tell us that the market's got to go through a correction just yet. So pulling it all back together, we're still very bullish based off the price action and based off the technicals. However, we are acknowledging that there is some downside risk that we have to acknowledge with hitting these price targets and seeing the VIX at these elevated targets, even though the market's going higher. So still look for the SP 500 to possibly come up and meet our 353 price target range. But just remember, there is underlying risk and underlying warning signs in this market. So trade and position yourselves accordingly. So good luck out there, everybody. Please remember to smash that like button on this video. It really helps me out, and I hope these videos are helping you guys out. And remember to subscribe to my channel so you can follow along on all of my updates. So thanks for watching, everybody, and as always, I will see you in the next episode.